Blast off. We're live. Well, we're not live. I keep saying that. I don't know why I keep saying we're live. We are recording. That's the way I should
We
say.
we
Anyway,
could do a live.
yeah, we could do a live. We could figure out how to do that one day. Um, yeah, well, this is another episode of Momentum Mondays. It is Monday, May 5th, 2025. Markets open in the wrong way, unfortunately. Markets down this morning. But we will kind of talk about what happened in the market last week, what we are looking forward to this week, and kind of give a nice synopsis of everything. So we'll jump into the returns. I'll kick it over to you for the disclosures so that everyone can be fully aware of what goes on here.
Yeah, absolutely. This discussion is for informational purposes only and should not be considered personalized investment advice. All investing, of course, involves risk, including the risk of loss. Past performance is not indicative of future results. Always talk to an advisor that you trust, or go to momentumwealth.us and schedule a complimentary consultation for a second set of eyes on your situation. But yeah, let's get into it. Rocky April. But last week did give market participants and investors alike something to smile about for sure.
Yeah, we had a really good week last week. It was good from a return standpoint. It was also good from a breadth standpoint, where we had many market participants advancing over declining. But again, last week we talked about this fact that the market sees many, many days of advancing, that it's almost, time for sort of a pullback when that happens, when you have so many days in a row that is that are positive returns. It's almost statistically unlikely that that continues without some sort of not giant pullback, but at least a down day or two. And we're seeing that today. We had one of these days last week where this kind of happened, where we were down and then we ended up. So we'll see what happens today. But wouldn't shock me if we ended down today. If we look at last week with the S&P 500, we were up 2.9, the Nasdaq up 3.4, the Dow Jones up 3, and the Russell 2000 up 3.28. Really good week last week. Let's look at gold and silver. Gold down 2.22, silver down 3.09, 10-year bond price down 0.21, which yield up, and Bitcoin up again. The second week in a row, it's been up 0.188. I mean 1.88. Sorry. And I do want to kind of add another slide in here, because we have this conversation and we've gotten this question a lot about rotating into international and emerging markets, which we did a few weeks ago. And they definitely have been outperforming year to date. The stock market, we'll get that in a minute, but week of 428 last week, international, we had up 2.35, and emerging markets up 3.5%. So you can kind of see, emerging markets actually was the winner of the week, as far as those returns are concerned, and what we're looking at here. But if we pull back and look at like a year to date, this is a graph of year to date. EFA is going to be our international holding. That is ex-US. There's not a US included in that. Emerging markets is the EEM, and then our SPY, which is our S&P 500 index here in the US. So you can see it year to date, and EFA is just really taken off. So this is the whole idea behind you know that diversification idea that we always talk about. We're not always in international, and we're not always in emerging markets. There are times and places for things. Certainly, past decade, domestic has really outperformed a lot. But you are starting to see the rotation. A lot of it does have to do with the environment of the U.S., where all of the tariffs and everything that's going on is making it maybe a less attractive spot in the shorter term for a lot of the international dollars to flow, and so they've got to go somewhere. Um, it's just kind of an interesting analysis to look at a 30,000 foot view.
Yeah, it's very interesting because you have, over the last decade and a half, really since the recovery from the financial crisis, you've had the dollar milkshake theory, which is where, in general, us being the prettiest state to the prom, is the U.S. economy is sucking capital from the rest of the world. I don't think that trend's going to change, but definitely there has been some rotation in the short term, and it's we haven't, it's really hard to put your finger on it. I think a lot of it could be, especially with the EFA, could be picking up on the end of the Ukraine war, kind of some stabilization in Europe, which is going to help lower energy prices. It's going to help the consumer. The ECB has been cutting rates faster than the Federal Reserve, so we're seeing an increase in the money supply there, a little softer monetary policy coming out of the European Central Bank. And then emerging, if you think of who really stands to benefit a lot from the decoupling that seems to be taking place from China, as far as trade goes, is Latin American countries, a couple of Southeast Asian countries. But if you really think about the emerging markets, a lot of these countries really stand to benefit from taking some of the cheaper goods production away from the Chinese. The market could be picking up on the potential of that as well, which is maybe why we're seeing such outperformance. But really, yes, a great week last week. Last week we were in our calendar effects trade, participated in that upside. When a lot of our indicators are turning more bearish, more negative, we fall back to our calendar effects position, which is really looking at statistically which set of trading days throughout the year has the greatest probability for return. And it's again has proved out to be a really great fallback strategy when the data is really not pointing you in a bullish direction for U.S. equities. Now, we've been in international, we've been in emerging here for a little bit and have participated in that upside as well. But yes, a lot of interesting developments. You are seeing the decoupling from the Nasdaq with Bitcoin, and also with risk on, risk off correlation to gold to an extent. Against gold wetted the bed last week, Bitcoin up in the opposite direction. So a lot of interesting things taking place in the market, and it really leads one to believe as to kind of what happens next. Like a lot of it really depends on your favorite word of the year, the breadth,
Good
market
word.
breadth.
Good word.
Um,
Really hard to
and we
say,
need
but a good word.
we we really need to see that. That's something that we have not seen in the beginning of this bull market, which I still think we're in. Um, Going back to the fall of 2023, concentration in the Mag 7 is what led the market. And we want to see the market breadth continue to start to really outcompete the performance of the Mag 7. And we're inching ever closer to seeing that. So,
Yeah. Well, the
you
most
know,
recent is the Mag 7 has fallen so far. So, that's sort of a that's that's a good point, but it's an interesting it's an interesting situation because yeah, is that played out? Is the rotation going to come out of that? It certainly looks like it is, and go somewhere else. And if it is, where is it going to go? Because tech's
yeah,
going
I
to have a
mean,
difficult time.
I think that it's all going to be relative. So, if let's say for instance you have the Russell 2000 double. Let's say rates are coming down, trade deals are made. Let's look at the everything goes right. Okay, let's see the Russell 2000 goes up 100% within a 12-month period of time. Will Mag 7 go up 80%? Possible. So I think it's going to be relative. In a bull market, I think it's going to be hard to see. I don't think you're going to see Mag 7 negative performance and index 20-25%, because they're made up. The indexes are so heavily
Yeah,
weighted to these
that's
larger
right.
companies. But I think it's going to be relative, and you're probably going to have some players that are going to come around. We've talked about Apple and their lackluster performance as it pertains to artificial intelligence, and you're definitely going to have some mid cap and small cap companies that are going to come in. Apple may even acquire some that are going to really outcompete in certain areas that some of these larger companies have not been able to compete in, as it pertains to artificial intelligence, um, um, batch computing, those types of things. And so you could probably see, companies double, triple, quintuple. That's going to be, taking advantage of opportunities that these larger companies have not been fast enough to take advantage of. So, I think it's going to be relative. But that's really what a healthy market is where you have a lot of pieces of the market that are going to really be outperforming, and you want to see that.
Yeah. Yeah, I agree. I mean, if we look at kind of some of the stuff that happened last week, kind of pivot away from that and into the next sort of section, we'll look at last week's GDP came back negative, first negative GDP print in 3 years. Um, what does that signify? What does it mean? Why was it negative? There's a lot of things that contribute to that. Certainly, the idea that a lot of US companies were importing a lot of goods in expectation that tariffs would come into effect and maybe they needed to kind of front load that. That certainly takes away from GDP because, again, that's not domestic production. And so, if you look at, Trump has been on the warpath about this, and whether he will be end up being justified is still yet to be determined. But you would have had a positive GDP print had it not been for the subtraction of those imports from that number. So it's
Yes,
interesting to
people.
look at.
Yeah, people are getting a crash course on how GDP is calculated. It is gross domestic product. So imports take away from that. In fact, it was the largest surge in imports in the last 5 years that made GDP be negative 3. In fact, if you go in and back out those imports and say what would GDP had been if imports in Q1 of 2025 would have been the same as Q1 in 2024, GDP growth rate would have been approximately 4.2 to 4.7, which
Yeah, so
reflects
does
a
that,
a significant robust underlying demand in the economy.
yeah, so what does that say for, people, a lot of people use metrics based on GDP to forecast future, economic stagnation or economic, the opposite of economic growth, or even recession. That's the definition historically of the recession has been two negative quarters. Um, and, we've seen that change a little bit with, who can say what a recession is. The last 4 or 5 years has been kind of muddied, but do we go back to that definition of it? And is it something that can be looked at as indicative of something that may put downward pressure on the economy or the growth of the economy in the future, or is it like an outlier? Should we not really be concerned with it?
Yeah, that's a great question. So you can really get into some very interesting uh, thesis theses. I'm not quite sure how the plural of thesis is. Forgive me.
Decide.
Uh, forgive me on that. But you can get some very interesting things when you start looking at this. So, and a lot of competing worldviews. But when you look at the underlying demand, and yes, imports are a part of the U.S. economy, and we see that there is um, a populist expectation that those become less important over time. And time will tell if that's actually going to happen or not. But if you strip out those types of import activity, and you look at kind of the domestic production, what's happening in the U.S. economy, because U.S. economy really came out of the COVID crisis the best in the world, even though we even though we did everything possible to not come out the best in the world. And there's all different types of points of views over everything that happened during COVID. But we really did a lot of things probably in hindsight we shouldn't have done, but we came out pretty strong. And so when you look at a pretty strong economy still, and you look at kind of everything that's being worked on, from tax policy to regulation policies to energy production to really a kind of a tear down the system and try to make it grow again kind of mentality that both sides of the aisle really want to happen. They just want it to happen in different ways. It can tell you some very interesting things. So let's get to the meat of it. When you look at the interest rates that we have right now, we still have the yield curve problem that's going on. And we're seeing really high rates on the short end. You have a few things that you can look at to say, okay, why would interest rates be high on the short end? One could be inflation. Now, the problem with that is that we don't see a really well-grounded inflation expectation of going back up, in expectations of inflation going back up. You're not seeing that in the sentiment. Also, you have demographic problems, and we have something else I'll talk about here in a minute that really kind of put a lot of questions on whether or not interest rates being high on the short end of the curve is directly, related to inflation expectations. I do not think it is. So you can if you're having high sticky short end interest rates, and you take out the import impact of GDP, you could ask yourself, wow, the market's really expecting the economy to continue to be pretty robust and to grow from here. So these higher interest rates could be justified. And you could ask yourself, okay, well, why is that? Why would someone have why would the market have low long-term inflation expectations? Uh, Expectations of a hot economy on the front end. And I think it's being driven by technology. I think it's being driven by the fact that artificial intelligence is about to wreck the system as we know it. And deflation is in a growing economy is much more of a realistic outcome than the return of the 1970s stagflation or runaway inflation. So I think that we could be seeing the market pricing in that possibility, which is again why I think the Federal Reserve needs to cut probably quicker and faster than what's been priced in so far, which is a 100 basis point total cut cumulative from all the Fed meetings for this year. And there's precedent for this. You go back to the early 1900s, you had perpetually inverted yield curve. You had a booming economy in the U.S. You had a lot of technological innovation, and you had deflation as a result. And I've been, I remember, going back to 2008 and getting a crash course on how deflation is the enemy of a central bank. And you look at the last CPI report, it's trending down, and I think that it's going to break the 2% target very, very quickly. And everything that's going on with the trade wars and the negotiations and all of these things, I think the front end impact of that is actually going to be deflationary pressure, not inflationary. And that is the exact opposite of what the mainstream thought is. But we could get into, lots of charts to look at that. But I think that there is at least enough information for that to be a possibility. And again, CPI is trending down. Trueflation is at 1.3%, which trueflation generally leads CPI by about 6 months. It picks up faster on both the up and the down. So it's, I don't know, very interesting. But all that being said, I think that a lot of times, and the market will do this to you. The market will do this no matter how much you absorb news and information. The market's going to educate you on what's really happening, and it's going to take some time. But a lot of times the things that you would expect to happen don't happen at all, and it's the unexpected that will in fact kind of rock your world, and make you realize how little you know about this market that we have.
Yeah, there's an adage that the stock market will do whatever it has to do to embarrass the greatest number of people.
Yeah.
And that tends to be true over time. But the other side of that conversation I would present is that we still have this issue with the 10-year yields standing at like a little over 4%, while to your point, the current interest rate is like 2.4-ish. And so historically, an elevated yield like this would suggest that investors are demanding the higher returns to be compensated for what they feel like is maybe some future inflationary concerns. So I don't know that the bond market's usually, you go back in the history of the market and look at the bond market, and it usually is there telling us what is going to happen before it happens. And so that's the concern here is with the bond market still acting the way it is. 10-year yields rose last week after a couple weeks of them falling. So we still have this kind of tug of war, this pull between, these bond investors demanding higher yields for what they feel like is more risk because of inflationary pressures. So that is something that can't be ignored, I don't think, when you're looking at the grand scheme of the Federal Reserve having to be in control of interest rates and kind of balancing this price stability metric with the employment metric, which you're starting to see. And I think you will start to see more, certainly as the brunt of a lot of the tariff stuff hasn't really taken effect yet. So I would look for that in trucking. I would look for that in dock workers. I would look for that in shipping. If we start to see a lot of that start to really struggle, if we see a lot of layoffs in those sectors, I would assume that we will see the Federal Reserve start to talk about responding to that. We've got Jay Powell talking on Wednesday this week. And so we would look to see what, if anything is going to shift his stance on holding. We're certainly seeing some of the Fed board chairs talk about, their feelings about their language having to change a little bit. But that's where I would kind of push back on that about the longer term inflation. I don't know. Again, we're at a point where we could go either way on a number of different things. Stock market could go either way at this point. The inflationary pressures could go either way. The rates could go either way. So it's like this whole, we're just kind of in a waiting point right now. We don't really know which, we're straddling the fence. We don't know
Yeah.
which way to put our foot down on because none of it's clear yet.
Yeah, it is. I think that in the short term, um, things can really go either way. I think that you have the reduction in costs by AI driven technologies is so mind boggling. It's something on the order of a 50% reduction in cost of every cumulative um, doubling of productive output. So it is
Yeah,
it's
but over what time frame?
well, that's
Because
a
you
good
have to
question.
pay for your capital expenditures. You've got Meta building these warehouses in the US, which is great. They've got to store the data. You've got Tesla doing the same thing. You've got a bunch of companies finding properties to do US based data centers, which is fantastic. But that costs, and it's not cheap. And
Yeah,
those are
so the
giant buildings.
just in less than 12 months, the the hardware and software cost, hardware has dropped 52% and software has dropped 45% as it pertains to, for instance, what Meta would use in those facilities. Um, with training costs for the artificial intelligence dropped 75%, and then inference costs have dropped between 85 and 90%. That's in less than 12 months. So I think that it's going to happen a lot faster than people think, but that still doesn't change what you're talking about, which is, the cost of building out specifically these facilities and getting the energy for them, regardless of what goes inside of them. And I think that's where, the pressure on the Fed is really there to essentially lower these borrowing costs. But I think it's going to happen regardless, because when you have this type of gravitational pull towards ultra low cost technology, there's nothing that can escape that. It may take time to do it, but there's nothing that can escape it. It's shocking. I spent the weekend kind of going over a lot of the data for the month of March in the AI space, and it's it's pretty substantial. So it's going to be very interesting to see how it plays out. But the trend right now, aside from the 10-year
Well,
CPI
even
and
tips.
inflation,
You look at tips too.
the trend is down. Yeah, because I think what are we on? We're down from 9 in 2022 to, oh goodness, we're at 5 or something with a four handle on it for the I bond. Did they just announce that last
Yeah,
week?
I mean, yeah.
But there
Well,
but there
a lot of the, yeah.
I mean, there's a lot of, it's so interesting, because when you're looking at the market the way that we're looking at it, we kind of have to create two different sides of our brain. We have to look at the weeks to months, and then the months to years. And so those, a lot of times those have two different two different, very different outlooks. And I think that there's a lot of weakness that has been permeating the US economy. Even though we've been the best in the world, there's still been a lot of weakness that's kind of been rolling upon itself ever since COVID. And that's, you see that in a lot of the ISM data. You see that in consumer spending patterns. You even see the high end consumer beginning to get hit, whereas the low end, middle class consumer has already been hit. So you kind of see this rolling pattern ever since the interest rates really went through the roof, which I'll remind people. I know people say, well, back in the 80s, interest rates were 12%. Yes, but they didn't go from 12% to 200%. The rate of change of the interest rate hikes that occurred is the greatest ever since the creation of the Federal Reserve in 1913. And that has impacts. We went from a quarter point to five and a quarter, five and a half. That is a giant multi-fold increase in the rate of change of interest rates. And that's really what impacts an economy the most is the rate of change of interest rates, both on the downside and on the upside. And so we're playing with a set of circumstances that we've never been faced with before. But I think when you look through the data and you look at those months to years, there's a lot of really great opportunity out there, and there is a changing, a shifting of the underlying long-term sentiment that I believe is to the upside. And those weeks to months, that's where things get really hairy. I was also watching Warren Buffett, who's he announced he's going to be stepping down as CEO at the end of the year. And he got a question about recent market volatility. And he simply said, "This is investing. There's nothing new here. It doesn't concern me one bit." And that's really the best way a long-term investor needs to look at those weeks to months. Now, if you're a trader looking at weeks to months, sure, you can make a lot of money and you can also lose a lot of money. But at the end of the day, that's all you're doing is you're take educated guesses on short-term movements. And there are people that can be really successful doing that, but they're very few and far between. And so that's why whether talking very positive or very negatively in those weeks to months time frame doesn't really matter. It's the months to years that matter to make a good investor that help build wealth and compound wealth over the long run. And so, yeah,
Yeah,
a lot of very interesting
like
data. In fact, it's so much of it. It's really, I did so much of a download this weekend that it's hard for me to even communicate um, the vast amounts. But I think that I'm not seeing
well, we
anything that's
appreciate
been
your effort. We
well,
appreciate
that's
your
fine.
effort.
I'm just, to wrap that part up, I'm not seeing anything that is making me change um, those months to years bias that I've had. That I believe inflation surprises to the downside, and I believe that the cost reductions driven by artificial intelligence and the electrification of transportation is going to be stout.
Yeah, well, those are also things that may surprise in the longer term. So, it's it may take a little while for us to get there, just like with all the
Yeah,
manufacturing stuff. But
yeah.
I did like what I enjoyed Warren Buffett's diplomatic answer on somebody asking him about Doge, and he said, "Well, I don't want to be the one to do it, but it probably should be done." Thought that was interesting.
Yeah,
Um,
I think that's probably the opinion of most people. And people disagree on how, and that's fine. And you may be right. Um, but yeah, I think he's been a multi-decade long critic of kind of government spending. I think
Yeah, he doesn't like to spend. There's a documentary or a camera crew that followed him around. We've talked about it before, but um, in a documentary they did about him and about kind of a day in the life of Warren Buffett. And he has two or three different meals from McDonald's that he'll drive through and get in the morning, and his wife will put the exact change in the cup holder next to him while he's going to work. And based on whether the market is up or down that morning, means he gets the less expensive meal or the more expensive meal. So, you know, even he is a sort of a penny pincher, and I guess that's why he is where he is. But we'll wrap this one up. We've got some conflicts on the calendar, so we've got to have a short one this morning. But we're watching for Wednesday. Fed Chair Powell speaks, so we'll watch for his tone signs of easing, especially after last week's GDP print. Thursday, we've got the jobless claims. So we'll look at that. That's also going to go into what the Federal Reserve is looking at. And then sort of consumer credit reports on Friday just kind of give us an insight into household financial strength and spending behavior. Um, so we'll see where that brings us. But that's sort of it for us. We are starting to see some improvements underneath in the market. It's probably not going to go straight up. We still are expecting of some volatility on the horizon. We are still watching our indicators, of course, and so we are acting accordingly. But yeah, if you have any questions about anything you've heard on here, if you want to reach out to us, get on our calendar, please do that. MomentumWealth.us. Like, share, subscribe, all of the above.
Yeah.
And we will be back here next week.
Yeah.
Well, maybe
Thanks.
not back here. Maybe we'll be in the studio next week.
Yeah, probably be in the studio next week. And we'll bring some interesting updates. We'll have some updates on some of the recent trades we've made. Of course, keep in mind that anytime we give an update on the podcast, it is not in real time. So I, discourage and warn against trying to copy anything that we talk about because there is a delay, and that's by design. So any questions, always go to momentumwealth.us, and we're more than happy to walk you through kind of our approach and the tactical portions of our portfolio, but they are not given to you in exact real time on this podcast. So, buyer beware, always reach out to us to get real time specific information.
Yeah, it's a good way to end it. We will see you guys next week, right back here.
Yep.
Thanks.
Take care.
Bye bye.
Bye bye.